to the Big Market Debate powered by Investonomics, an initiative by ICICI Direct. Joining me today is Mr. Arun Malhotra, founder, partner, and portfolio manager, CapGrow Capital Advisors, and Mr. Dhaval P. Vyas, founder, dhavalpvyas.com. Welcome, gentlemen. My first question is for Arun. Arun, party is on. Bulls are not letting it go. So, what is your view on the markets? How would you, play in the markets at current levels?
Thanks for first of all, thank you for having me on the show. I think our view, house view, is very clear. By most of the metrics, the markets are looking expensive. There are signs of speculative excesses in some pockets, especially the small and the mid caps. And there have been too much retail participation, which is for us is a red sign.
Okay.
And there is the investors are extrapolating the last 12-15 month returns into the future, which again to us is not the correct way to look at the markets. So we are a little cautious at the moment right now.
Dhaval, what do charts say? I mean, how do you approach the market at these levels? What do Nifty charts advocate at these levels?
Hi, thanks for having me in this show. See, the thing is, Nifty has been in uptrend from quite a long time, and there haven't been any noticeable or considerable corrections in between. So the point is, many people would have missed the rally of this market from 12,000, 13,000 onwards. So that's fine. But the point is, whenever the market gives you an opportunity or market is seeing some good buying interest, there is a point or the market is a kind of telling you that buy this trend and make some money. Right now, the trend has been quite up, but the bulls are looking a bit tired. So we feel this is not a great level to enter into or to make a fresh portfolio. You keep buying on dips. Say 3 to 500 points of correction in Nifty will be a welcome step for uh, up move to continue. Just because whenever there is an uptrend, there should be some correction here and there. That is a sign of healthy market. So we will be fine in case there is a correction to the levels of say 16,850 or 800 levels. That could be a kind of good sign that the market is in the right direction. Overall, we feel this is market which is heading towards 19,000, 19,300 spot levels in Nifty in next 1.5 year. So 12 to 18 months target remains that, while Sensex also is having same kind of upside potential. But the point is, whenever the market is giving you a bull run, just participate.
A trend is friend, you want to say.
Exactly.
Arun, you just said that market valuations are stretched and markets look quite stretched. Assuming that we have a correction of, say, whatever points, 400 points, 500 points, what will you buy more? And where do you think that one needs to be cautious if there's a correction?
I think first of all, we need to acknowledge that some sectors have been deeply wounded by the pandemic. The sectors like hospitality, travel. So there might be some partial recovery or maybe an opening up trade in those pockets where there is deep value. Those stocks are not moved at all.
Mm-hmm.
There is definitely a risk of third wave, coming in. But as the vaccinations have been going up, our belief is that the third wave, if at all it comes, would be much, much less severe. And more so because the hospital infrastructure, which was lacking last time, has been improved to a large extent.
Right.
We feel if the correction happens, banking has not participated in the last 6 months.
Sure.
Likes of Kotak, the likes of HDFC, they have not participated at all. I think that like some of the banks, SFB, like Bandhan Bank, would be at a low in the last 12 months, near its lowest levels. So there are still a lot of pockets left in the financial sector space where you could find value emerging, you could find stocks. We feel a lot of structural changes which have happened in the last 5 years, especially related to the financial sector, the financialization of Indian economy,
Right.
NCLT case approvals, then the Jan Dhan Yojana. So a lot of things have actually given a big push to the Indian financial sector, and the biggies, the SBIs, the Kotaks will do well going forward. And one important aspect in the financial sector is there have been five big PSU mergers that has happened in the last 4 or 5 years. So
Right.
the consolidation has already happened. We are already past the NPA cycle. We are on the cusp of a big increase in profitability for the financial sector.
Uh, Arun seems to be quite optimistic about the banking space going forward. Dhaval, anything you like in the banking space now? If you see the HDFC twins and the Kotak on the charts, they have started looking up.
Definitely. See, HDFC Twins as well as Kotak is looking good. Kotak especially has been facing a resistance of say around 1800 constantly, and it has been able to break it. The point is right now what to buy and what is looking good
Okay.
chart wise. If I had to select only one stock, say out of this whole banking space, then it should be basically ICICI Bank. ICICI Bank chart is looking quite good. Great technical structure overall in place. Strong momentum is continuing right now. We feel if you can hold it for let's say 12 to 15 months period, then the stock is likely to move towards 930, 970 zone. So ICICI Bank remains the top pick among the banking space.
Do you like anything in the PSU banking space, Dhaval?
For PSU banking space, we feel any dips in SBI towards the levels of 380, 370 zone will be a welcome step, and we can add into SBI. SBI overall should be on hold for next 2 to 2.5 years. The point is, we are just we had just been moving in the same range from 2010, 300 to almost 180, 160 on downside. So we have broken that range. So we feel 560 and 630 is the levels to watch out for SBI in next couple of years. So SBI remains the top pick among the PSU banking.
Arun, how much cash are you sitting on right now? Because since you think the markets are stretched and the valuations are roof high, are hitting roof highs. So, what is the percentage of cash that you're currently sitting on, and what levels do you think that you'll deploy that cash?
I think that's an interesting question. The cash levels would be in the range of 8 to 15% across portfolios, which have been there with us for more than 3 months. Uh, at what levels we will invest? We continue to find opportunities. As I mentioned, the financial sector has not, participated. We have seen correction in some of the pharma names, and pharma, we think the domestic pharma story continues to do well. We have seen price erosion in the US generic space, but companies which have domestic formulation business, I think will continue to do well, especially post pandemic. So there are opportunities, but what I meant was cautious is the returns of the past 12, 15 months, which have been anywhere between 50 to 100%, should not be extrapolated, and the return expectation from the market for the next 12 months should be subdued in the range of 12 to 18%.
Think on IT sector, Arun. Would you like to still buy some of the IT frontline stocks?
IT, the demand has been very strong, and we feel the stocks have also reacted in that direction. We feel digitization, the cloud computing, these are the themes of the future. The AI, the machine learnings, and those stocks will do well. In terms of price, they have already seen a considerable price rise, but I think they should be part of everybody's core portfolio.
Dhaval, what do you like in the IT space?
Your favorite picks have been Mindtree and Tata ELxsi. We still feel Mindtree has some more upside towards say 4500 and 4900 levels. So the current zone is basically around 3760. So we still feel there is an upside of nearly 33% in Mindtree. But as far as Tata ELxsi is concerned, which is at trading around 4900. We had been recommending to clients as a disclosure from 1400. But the point is, Tata ELxsi still remains a good buy at current levels of 4900 into a zone of 4700 on dips. So if you can hold this stock for say next 1.5 year to 2 years time, then we feel this is a stock which can still outperform the markets for a target of nearly 7200 and then 9000.
I don't know if we talk about the commodity cycle. We all are saying now that we have a super commodity cycle. We have just started, and the cycle is going to pan out broadly, affecting sectors like cement, and we have seen pricing power returning to cement companies. We have seen the balance sheet of the cement company, steel companies, really getting into shape, back into shape. So, what is your view on the commodity cycle? Is this commodity up cycle going to last for a few more years?
I think commodities, we can separate those commodities into two. One is the international commodities like steel, copper, while cement is still more or less a domestic commodity. Uh, I believe we are not a big fan of the international commodities, which get impacted by a lot of factors, and it is very difficult to get a good hold on those factors. Steel, copper, iron ore price at $180 per ton, I think is too excessive and is not going to sustain there. When will it start falling? I don't know. I don't have the answer. Neither does anybody have. So these trades have become very riskier now. And coming to the cement, I think the real estate, especially, is at the start of a big boom cycle. If you see, the real estate prices have not gone up in the last 8-10 years, while the RERA has brought lot of formalization to the real estate sector. When I say formalization, means the unorganized players have gone out of the system, while the organized players have become much more stronger. So with mortgage rates at lowest level, at least in my life cycle, and real estate prices have not gone anywhere in the last 5, 7, 10 years, and then the work from home has led to increased space requirements for everybody. So real estate is at the cusp of a good 5, 7 year cycle, plus the infrastructure that will drive demand for cement, and hence cement we will see continuity in good demand as well as reasonable pricing.
Around the companies that you like in the real estate space?
As a PMS registered, we are not supposed to name companies, but that as a sector we like it.
Dhaval, as far as the charts of the companies like overall Oberoi Realty, your DLF, what are they indicating?
Yeah, Oberoi definitely has some upside potential, and we feel from the current levels of 773 can move up to 830, 870 in next 15 to 18 months. But if you had to pick one stock which can outperform most of the real estate space, then it should be Brigade. Brigade is looking quite good. Uh, Overall, the chart structure has been quite strong in the stock overall, and we have been seeing some fresh buying coming into the stock. Around the current levels of 398, we feel this is one of the best pick in the real estate for a target nearly 575 in next couple of years. So overall, the upside potential is quite good in Brigade, and the risk reward is also good. Second stock after Brigade will be Godrej Properties. Godrej Properties also showing some momentum. It had been going through a kind of consolidation. So we feel Godrej Properties can still give some good return from the current levels of 1600. The upside potential is till the levels of 2150, 2200 in next couple of years. So both the stocks should be in portfolio. At least some lower exposure should definitely be there in your portfolio.
Arun, lately we have been seeing sector rotation happening, but there is no clear-cut one leadership that is emerging among the sectors that we have. I mean, do we expect this kind of a leadership to come in times to come? Because sector rotation has to stop somewhere, isn't it?
I think still the next 12 to 18 to 24 months would be led by financial sector, IT, and pharma. I think these are the three sectors and obviously real estate, as I mentioned, the drivers of real estate. So sector rotation is just a normal human tendency. If the stock has gone up by 50-70%, you tend to reduce that and try to put in a stock or a sector which has not performed. So that things will keep happening, in the market. But bigger money, the big money would be made if you continue to hold those your winners.
How should one anchor the portfolio for, say, next 6 months, Arun?
Uh, Large caps, the clear preference should be towards the large caps, and majority of the large caps offer you the best risk reward in the current situation. A lot of them have even not performed in the last 6 months to 12 months rally. The formalization of Indian economy, the domesticization of the Indian economy, a lot of China plus one factor, a lot of manufacturing is coming to India. The large cap companies would be the biggest beneficiaries, no doubt. The small mid cap, which are, as part of the current rally or which are the parts of the WhatsApp group messages, they probably are going to crash and probably will not do well, while the large caps will show a decent amount of earnings. When I say decent, anywhere between 15 to 25% for next 3 to 5 years. So that's the best sweet spot where most of the investors should be.
But Arun, talking about the valuations of the large cap, I mean, they are quite stretched. I mean, some of the stocks are available at 60 multiples, 50 multiples. Is it wise to really invest in those stocks where the valuations are sky high?
See, the I think that's where a lot of investors miss, because when we say 60 times earnings, the E is in the denominator and E is subdued. So that's where we have a different perspective, that earnings will increase and these P's which are looking higher to you right now will be much moderate, maybe 12 months down the line. That's one. Second, there are a couple of sectors which have not performed in the rally. I gave you one example of financial sector. Then you look at media. The media, you have Sun TV, Z TV, and the print. I'm not talking about the print because that's a dying sector. But those stocks have not done anything in the last 3 years. And they are available at 10, 11, 12, 13 times earnings. And mind you, some of these businesses are cash flow positive in the last 10 years. All 10 years they have been cash flow positive. So as the economy improves, we will see higher advertising, higher subscription, and these stocks are available at normal, at a PE of 10, 11, 12 on a normal earnings. So if the earnings increase, those PEs would become much smaller, and I think those stocks where you can have tremendous returns. There are enough ample opportunities, I would say, if you just, I would say, broaden your lens.
There are three stocks I would like to ask about is Bharti Airtel, which has given a breakout, trading at all-time high. Reliance, again, it has given a breakout, trading at all-time high. And ITC, which has not moved at all. I mean, stuck in a range of between 200 to 250, not moving at about 240 at all. So what is your view on all these three companies?
First, we will talk on Bharti. Bharti has been showing some good strength from last couple of weeks. We feel Bharti is already into uncharted territory, and that is the best time normally to get into a large cap stock, just because something new is happening around the stock or company. Bharti at current levels of 685 is quite good for a target of nearly 770 in next 1 year's time. Overall target remains 830 for 15 months time period. So Bharti definitely remains good. You buy on any dips towards 650 zone. Next, Reliance is again seeing some good momentum. We had been always seeing in Reliance last, if you just compare last 1 year, especially last 6 months, then any dips of nearly 5-7% have been bought into Reliance, and we feel this stock is again moving into a very good zone. So overall, we are still comfortable having a fresh long trade in Reliance investment idea at 2400, and we feel this stock has the potential of 2750 in next 1 year's time. But ideally, we feel the holding period should be at least 2 years, so that the real potential of this basic move can be captured, because we have been forming a kind of base in Reliance last few days, last few weeks, and now the stock is trying to move towards the level of say 3150 levels in the next couple of years. So we definitely feel Reliance is still a stock where you can initiate some fresh buying. As far as ITC is concerned, it has been a kind of underperformer in everybody's portfolio, but not performing well. But overall, the risk reward wise, the stock is looking good. The momentum is definitely not bad. With a stop, good support around 196, we feel ITC can be kept with a kind of lower exposure of say 3 to 4% in your portfolio, and we can expect nearly targets of 260 to 265 in next 15 to 18 months. But this is not a stock for the kind of aggressive investor. This is for passive kind of income generator, or if you are looking at kind of uh, zero kind of volatility in your portfolio, then ITC is one of the safe avenue for sure.
Arun, the biggest threat for the markets, I mean, the biggest worry on the risk for the markets?
I think if you ask me, it's the global risk. That's the biggest risk for Indian markets, primarily because the accommodative nature of the US Fed, the loose monetary policy, the investors are expecting that it will continue forever, for indefinite periods of time.
Right.
Some way or the other, they are going to stop this quantitative easing, maybe taper it down, and that will cause inflation. We can also already see some signs of inflation in the US. So in the US, the bond prices are at highest levels. The mortgages are at high, real estate prices are at high. The equity markets are at all-time high in the last 18 months or 24 months. So most of the asset classes in the US are at high. And once the interest rates start increasing, we probably will see some money, some liquidity flowing out of these asset classes. How the markets will shape then, whether it will be a mini crash, major crash, I have no answer. But what I can see is definitely we will see some softening in asset prices going forward. That remains the biggest risk for all global markets. Uh, I think, having said that, I think India right now is at an inflection point. Last 10 years, if we see, we have seen subdued earning cycle for majority of the Indian companies. Corporate profits as a percentage of GDP are at the lowest, somewhere around 2.6, 2.7. Uh, this earnings trajectory will show an upward trend for majority of the Indian companies going forward. Next 10 years uh, will be driven by lot of earning increase for Indian companies, driven by the measures which has been taken by the government. As I mentioned, some of them, the GST, the NCLT, the financialization of Indian economy. So then a lot of FPIs are investing. We see a lot of internet companies are coming. So these are all expanding the Indian markets, and hence Indian markets, we will continue to see opportunities for investing.
Dhaval, any top picks in the mid cap and the small cap space that you have?
Definitely. See, in medcap space, there are basically two main picks from our side. Kaplan Point Laboratories, which has moved in the recent times also. We feel this still remains a very good pick. Technically, the structure is good, and fundamentally, the stock remains good. Kaplan Point can be bought around 940 current levels, even on dips to 900, for target of nearly 1300 in next couple of years. Second pick is Havels, which is a kind of now large cap, but this stock is still looking good. Overall, we feel that this stock has a decent upside from the current levels of 1450 for a target of nearly 1750 in next 1.5 years time. And third pick actually is from IT space. We feel like LTI is still looking good, around 5440. Any dips towards 5200, 5100 will be a very good entry point for a target of nearly 7300 in next 2 years time.
Arun, we have seen a rush of new investors entering in the market. What will your advice be to them?
It's a very simple, plain vanilla advice. Uh, Exit all WhatsApp groups which offer you advice. That's number one. Second, be cautious. Do not extrapolate the returns. Increase your time horizon from 1 day, 1 week, 1 month to 6 months, 1 year, and maybe longer. And thirdly, give it to specialized investors who have knowledge. Do not speculate. We already have seen frenzied issuances in terms of IPOs, FPOs, and selling by insiders, promoters. So these are clear signs that knowledgeable investors are exiting while retail investors are entering those stock positions. So we have to be very cautious of this crazy investment behavior, and that would be my advice to the retail investors. It's not the time to add risk; it's the time to reduce risk.
Right. Dhaval, your advice for the newcomers. I mean, technicals is something which everybody is trying their hands on. So, what is your advice to them?
See, it's basically like cricket. Market is like cricket, you know. From outside, it looks easy to play the balls and, to throw a ball here and there. But when you get into a real pitch, it becomes quite difficult. Market is basically a kind of war of brilliant minds. So many, thousands of minds, lakhs of minds, which are trying to gain some, profit. So the point is, if you are not disciplined trader or investor, your money, your whole capital can be wiped off in very few months actually. So the point is always be disciplined. Keep your stop losses defined, even for investment purpose. Your criteria should be defined. If you are investing for a particular reason and that reason is no more existing, then there is no point into holding on to that investment. So basic philosophy should be, keep your risk criteria limited to your risk profile, and then enter into markets, and always be disciplined. That is the success mantra for trading as well as investments.
Thank you, Arun. Thank you, Dhaval, for your time. It was a pleasure speaking with you. A good
Thank you.
insight into the markets. Thank you so much.
Thank you. Thanks for
Thank you.
having us. Yeah, thank you.